Welcome to the monthly roundup from Kepler Trust Intelligence in association with Schroders. In this edition, Ryan, David, and I will be covering all the news in the investment trust world over the month of March. Ryan, could you kick off proceedings by talking us through some of the most notable news stories from the last month?
Of course, Joe. We start the news section again with a return to some of the more activist activity in the sector. Now, as we mentioned last month, there is a new trust on the block called Achilles that involves industry specialists Chris Mills and Robert Naylor. They announced the first of their targets in March of Urban Logistics REIT, aka Shed. Shed specializes in last mile distribution networks, so that's sort of the last link in the chain of those online deliveries that you will get. Now, this area has been sort of a rare bright spot in the property sector over the past few years because of those good structural drivers, although Shed has been trading at a discount for the best part of 3 years, along with much of the sector primarily as a result of the higher interest rate environment, etc. However, the reasoning behind the action of Achilles has actually been centered on corporate governance. There have been questions over the closeness of the relationship between the board and the management, some cross ownership with the third party company and the manager, and then plans to internalize the management team all being raised by Achilles.
So, what implications does this have for the trust?
Well, we won't go into the details because there's been lots of claims and counterclaims which are still ongoing. The situation remains very fluid. But I think the involvement of other parties, such as Marcus Fair Mudge of TL Property, is really interesting because it shows that despite Achilles only having quite a small asset base of its own, they're clearly looking to collaborate with other industry specialists to try and unlock value for shareholders. So as such, I think boards are likely to be particularly focused on the threat of activist activity and hopefully have some more shareholder-friendly approaches to come out.
And this isn't the only launch on the radar.
That's right. The IPO roadshow of the RM Catalyst Trust has been circulating. This is doing something similar, looking to build an asset base and go after some of the wide discounts in the real assets sector. This is again adding to the argument that many specialists and experts believe that the discounts on offer in much of this space of the investment trust world are particularly opportunistic at the moment, and these could provide some fast-moving developments.
Yeah, we're seeing a lot of kind of that opportunistic events happening, and M&A in the sector has kind of continued as well.
Yeah, that's right, David. We saw two trusts being the subject of takeover activity in the month. Firstly, there was Warehouse REIT, which finally succumbed to a fifth bid from the private equity group Blackstone, around 115 pence per share, although there's some consideration needed for the dividend. But more importantly, this is a 40% uplift on the price before the bidding started. So while it is still a discount to the manager's figure of NAV, it just goes to show what value there is on offer in the sector.
And M&A hasn't been concentrated just in the REIT sector, right? There's a lot happening in real assets. Tell us what happened to Harmony Energy.
Yeah, of course. Month also saw bidding activity for the battery storage trust Harmony Energy. This came ultimately down to Drax, who are sort of famous or infamous, depending on your view, of the eponymous power station in Yorkshire. Harmony has also received bids from Foresight Group, though these were ultimately outbid for by Drax, who is now going through the motions of proceeding with that bid. So again, both an investment trust specialist in Foresight and sort of wider parties recognizing value in the investment trust sector. This arguably creates an encouraging read across for not only the other two remaining battery trusts, but also for real assets more generally. Sector, especially the battery sector, had been hit by some sort of idiosyncratic factors around the energy crisis over the past couple of years, though this news could spark the sector back to life, in our opinion.
And finally, we saw a proposed change in strategy for Schroder British Opportunities. So could you talk us through this one, Ryan?
Of course, though, firstly, we'll just provide a bit of context for those who are not fully aware of the story. SBO launched in 2020 with the goal of identifying the best opportunities for a mixture of private and public markets. In its relatively short life, the private holdings have been the primary driver of performance, with the portfolio of unquoted holdings valued at the most recent results at around 1.5 times their cost. Following this, the trust has announced plans to move fully into the private space, and so disposing of its public equity portfolio, which made up just under a quarter of NAV, and using these proceeds to reinvest back into the private portfolio, although all of this is subject to shareholder approval. The trust isn't the largest, just sort of circa 80 million of net assets, so freeing up this capital to invest elsewhere in what they think is a very good opportunity set in private equity is a sort of rare opportunity for the managers.
And what does this mean for its future, do you think?
Well, as the private holdings were more successful, it allows the managers to specialize in this area, which could support future performance, especially if the portfolio sees an exit, which would obviously be a real boon to returns. Furthermore, it puts a discount under a bit more scrutiny. We've often highlighted the high level of discounts due to that sort of split of the public-private weight, and the NAV for the sort of public holdings was very determinable. However, with these holdings, some of these holdings being realised and the cash being put into private holdings, it arguably makes the level of discount sort of more transparent, and investors can make quite a straight call on what they think that portfolio is worth. The discount level hasn't changed very much since the announcement. It's currently around 38%, and this is pretty much the widest point in its history, so it could well prove an opportunity for some. So moving on from the news, it's time to discuss our events over the past month. Now, March played host to KTI's Ideas for Your ISA event, where we held a range of webinars to show the number of options available for investors to put their money in.
Yeah, now we had a good dozen presentations, so there's not anywhere near enough time to kind of go through all that in this podcast. But we will just have a look at some of the highlights. Joe, could you talk us through the key points from the webinar with the managers of International Biotechnology Trust?
Yes, by way of a 10-second overview, IBT offers exposure to the complete biotech life cycle. So from the earlier stage private companies to the larger cap NASDAQ listed companies too. And on that front, Alstomeric continue to see attractive valuations in the sector, with around 20% of biotech companies trading below their net cash position. And that compares to less than 3% in 2020. So quite a significant rise on that front. They also spoke about an increase in pharma pipelines chasing the same targets in some areas. So, for example, there's 5 assets on average chasing each target in oncology, but only 1.5 outside of oncology. So as a result, they've reduced their exposure to oncology because it's become harder to pick the likely winners.
And we've previously spoken about Big Pharma turning to M&A to plug their patent expiry cliffs from some of their blockbuster drugs. But has the change in administration in the US put the brakes on this?
Yeah, we have spoken about this in previous podcasts, and the managers spoke about the industry evolving now into a clear division of labour. So you've got biotech providing the innovation and big pharma providing distribution networks so they can market new drugs as quickly as possible. But coming back to your question, yes, Alstomeric saw a clear hiatus in M&A from around February to September last year, obviously ahead of the US elections. But it has since resumed in earnest. January marked the third time that IBT's largest holding was acquired, when Johnson & Johnson bought Intracellular Therapies for $15 billion. And that makes it not far off 30 acquisitions for the trust since 2020. So the managers have really demonstrated their prowess in picking the most attractive biotech targets.
And it's just kind of an overall kind of view. I mean, what do they get the sense of from the Trump administration? Is it likely to be kind of net positive or neutral for the biotech sector?
I think in short, net neutral. They felt a change in head of the FTC could spur further M&A after a dry spell. The previous head was quite anti-M&A, so that should be a positive. They believe RFK is harder to gauge, so his focus is likely to be on food additives and the likes, but he may want more research into vaccines. And they feel that the other key appointments look sensible.
And I will change to something totally different. Ryan, you hosted Cordiant Digital Infrastructure. What did Stephen Marshall have to say?
Yeah, thanks, David. So Stephen gave a sort of quick overview of Cord's strategy, which involves investing in a range of real assets linked to the digital economy. So it's things like broadcast towers, data centers, and fiber networks. Now, these are held across most of Europe and then some in North America. Stephen gave a brief of what has happened with Cord in its relatively short 4-year history, including the multiple raises of the dividend, the additions of several assets in and around Belgium, plus other bolt-on acquisitions, as well as the recent restructuring of the debt facilities, which has significantly reduced the refinancing risk. He then went on to give an overview of what the current portfolio looks like, which is 6 companies at present, though is significantly diversified across asset class and from different revenue drivers. This then evolved into a discussion of how they manage this portfolio, including a run through of their buy, build and grow approach. Now, this is designed to help differentiate the trust from other infrastructure vehicles, as well as help deliver on its goal of giving 9% annualized total returns, which the trust is currently ahead of since launch. Now, these are just 2 examples of the events we hosted, with plenty more for you to catch up on. So to watch back and see the presentations or for any of the following trusts, please visit the web events part of our website. And here you'll be able to see presentations for Alliance Witan, Baillie Gifford UK Growth, Ashoka Emerging Markets, Vietnam Enterprises, SDCL Energy Efficiency Income, Global Smaller Companies Trust, Schroder Real Estate, and Rockwood Strategic.
Quite a long list there, Ryan. Thank you for covering those. Moving on to results. What results have caught your eye this month?
Yeah, thanks, Joe. So firstly, I'd like to start with Schroder Asia Total Return, which had full year results to 31st of December 2024, so quite neatly fitting in with the calendar year there. The headlines are pretty strong. The trust outperformed both its reference index and its peer groups with a return of 13% in total return terms versus 12.1% and 11.7% respectively for the reference index and peer group. Because of this, it now marks a quite impressive 9 out of 10 years of outperformance. However, this was very much a year of two halves. The first half saw really good contribution from the long-standing allocations to the tech holdings, such as TSMC, though the Chinese stimulus measures dominated markets in the second half of the year from September onwards, which proved sort of a more headwind-style environment. Despite this, factors such as good stock selection, especially in the region's more developed markets, drove outperformance overall.
And how has this performance been reflected in the share price?
Yeah, slightly surprisingly, despite another year of NAV outperformance, the share price failed to keep up, rising only 12.6%. As such, the trust discount to NAV has risen to 5.1%, although we should point out that it is the narrowest still in the peer group. This has been aided by the considerable share buybacks that the board has undertaken.
And was there any news on any of the other trust specifics?
Yeah, the managers have been quite active with their level of gearing throughout the year, although the headline rates won't indicate that. Beginning of the year, it was around 7.8%, 8.5% at the end, although the range swung between 3.8 and 8.8 in the year, showing good active management. The managers also began using CFDs, contracts for difference, in addition to their existing loan facilities, which has provided them better flexibility and more cost effectiveness considering the rate of borrowing at the moment. And whilst the trust is primarily focused on capital growth, it does pay a modest dividend, which was held at 11.5 pence per share. And this offers a yield of around 2.5% on the current share price. This was slightly more than the earnings that were generated in the year. So a small amount from the trust's very sizable revenue reserves was used to support the dividends. Now, narrowing down from Asia more broadly to focus on India specifically, David, what updates do you have from the country?
Yeah, now obviously, the sell-off we've seen, the correction in US markets has taken headlines quite a lot. But one of the quieter trends that we've seen in recent months has actually been a sell-off in India markets that happened kind of between late September last year and early March. The Sensex fell in total about 15% during that time. It has bounced a little bit since. Now, it's worth pointing out that came after a very strong run. And the India market has actually returned more than the Nasdaq over the past 5 years. But into this, we had some half-year results from Ashoka India Equity, AIE, which encompassed the start of this sell-off. Now, I'm sure no one will be surprised to hear that the results were pretty good. During AIE's 6 months to the end of December, both share price and NAV returns were just above 5.5%, which is especially impressive when you consider that its MSCI India IMI index fell by 2.7% over the same period. AIE was helped by its strong stock selection within the mid and small caps, which is a continuing theme for AIE. Healthcare firms such as IKS Health and Newland Labs were particularly strong contributors.
Thanks, David. And sticking with AIE, you spoke to Ayush from the Trust Investment Advisor, White Oak Capital Management. What did he have to say?
Yeah, so Ayush was keen to talk about the sell-off broadly, which he kind of sees as a healthy correction, if anything. Of course, corrections are kind of par for the course when you're investing in equity markets and particularly in developing markets. And Ayush hopes that it will kind of allow the market to build fresh legs for the next rally. He did speculate over 4 potential reasons for the sell-off, which I won't go into too much detail here because you can obviously have a listen to the podcast yourself. In terms of the attractions of the India market, and there are still a lot there, Ayush talked about the burgeoning IPO market and the breadth and depth of the market in India. There are thousands of stocks listed over there. And unlike some of its developing country peers like Taiwan and South Korea, it's quite a broad market, heterogeneous. So you get good diversification.
And back to you, Ryan. You've been looking at the results of BlackRock American Income, I believe.
Indeed, yeah, we saw BRAI release its results for the financial year ending 31st of October 2024. These came out in March. Now, normally with these results, we'd sort of cover off the performance, the dividends, but these can all be read in the piece on the website. But in this case, there was sort of quite a range of announcements on a series of proposals covering a new process, the introduction of an enhanced dividend, and a cut in the charges, as well as a number of discount control measures put in place. So, taking these in order, the new process will adopt BlackRock's systematic active equity approach that uses data and AI alongside manager input to help select stocks. The enhanced dividends will consist of quarterly payments of 1.5% of NAV. Now, this will use a contribution from capital as well as the natural revenue generated by portfolio. And this means the trust will pay sort of quite a high income from an asset class not typically associated with one. And then there is a conditional tender offer as well. This will be every 3 years for up to 20% of the shares at a discount to NAV of around 2%, which is designed to help narrow that discount. Now, these are quite a wide range of proposals, and obviously there's a lot more depth to each of them. So for those interested, I'd really recommend reading our results analysis piece on the website.
Now, moving on from results, we've already covered one podcast, but I think you've recorded a slightly closer to home podcast as well, David.
Yes, so I spoke to Matt Benison, who is a fund manager on the Schroder Income Growth Trust. And one interesting thing that he kind of talked me through was the increase that we've seen in UK companies buying back their shares. Now, this is something that's been a big feature of the US market for a while, but it's taken a while to travel over this side of the Atlantic. But it's certainly kind of taking off now. Matt noted that the proportion of companies buying back more than 1% of their equity a year has more than doubled from 20% to 45%. And it's actually now more than in the US. Now, this is a good thing, but Matt did note a kind of word of caution over what it means for income investing more broadly, because some of the cash that's being used to fund those share buybacks is being taken from dividends being paid out.
And talking of dividends, Joe and David, you've recently published a special report on investing for income. What was the key theme here?
Yes, the report aimed to debunk the myth that income-seeking investors have to sacrifice growth in the process. So Dave and I took an in-depth look at sectors offering a dual mandate, from commercial property and UK mid-caps to Asia and Japan in particular. Unfortunately, we only have time to provide a brief taster, but you can find the full Moving with the Times report on our website. So picking just one example, Asia actually offers higher yields than some of the traditional equity markets in the UK and Europe. Plus, you've got the growth story in Asia. So you've got diversified growth drivers from the semiconductor expertise in Taiwan and Korea to the growing consumer class across the region. And if you take two of the Schroders funds in this region, Schroder Japan and Oriental Income, not only do they offer a 4% plus dividend yield, but they've also chalked up a share price return of around 100% over the last 10 years. So pretty impressive in terms of both income and capital growth.
Yeah, but it's definitely worth not ignoring the obvious. And UK equities can still play a role in an income portfolio, certainly with the FTSE 100's cheap valuation at the moment. And actually, if you kind of dig in a little bit deeper, the yield difference between the FTSE 100 and the FTSE 250 is around as small as it's been for a long time. Mid caps on average have a yield of about 3.3%, which gives you good income potential as well as the prospect for good capital growth as well. In fact, in local currency terms, the FTSE 250 has returned more than the S&P 500 over the past 25 years. Now, that's a very unfair starting point, and we're cherry picking the data a little bit since we're starting at the kind of start of the dot-com bubble. And in pound sterling terms as well, it's a different story, but it's kind of still very impressive, and it gives you a good kind of, a good sense of the attractions of the mid-cap market.
Absolutely. And staying on the topic of dual mandates, David, you spoke to Zina Shahaiba from JP Morgan European Growth and Income. What did she have to say about the outlook for investing in Europe?
There certainly seems to be a renewed enthusiasm for European stocks, and Zina gave us a good overview of the market. We talked a little bit about Europe's tech sector, as well as the fact that European financials have more than doubled over the past 5 years, and given as good as they can kind of get versus the US tech stocks. We also spoke about European defence, which is obviously an area that's kind of soared recently amid reports of rearmament. The most obvious beneficiaries of higher defence spending have doubled in no time. But Zena thinks that there are other areas that will benefit too, and you can find out what they are in the podcast.
And we've seen signs of cooling towards US equities in the last couple of months. Joe, was this evident in terms of the most popular trusts with UK investors in the last month?
In all honesty, not really yet, as UK investors continue to hoover up global funds. So once again, Scottish Mortgage and JP Morgan Global Growth and Income vied for top honours. F&C and Greencoat UK Wind made it a hat trick with their third consecutive month in the top 5. Now, it made a fleeting entrance on the list back in November, but Allianz Technology Trust was back in favour in February with UK investors. It's very Magnificent Seven heavy, so I guess investors were indulging in a bit of bargain hunting. Obviously, the value of the underlying holdings fell, plus the bonus of a 10% odd discount to NAV. So I guess a cheap way of adding some exposure to the US mega caps if you're of the opinion that recent events are no more than a short-term slump. Now, David, you've just written once again about your personal portfolio. Not sure if you hold any of these trusts, but what have you been thinking about in light of the rotation away from US equities?
Yeah, I do hold a couple of those trusts, but I haven't spoken about them recently. We actually saw an interesting survey showing that global fund managers had reduced their US stock exposure by the highest monthly proportion on records, which is unsurprising given the ongoing correction. Instead, they're putting their money into Europe. Kind of with that in mind, I thought it might be worth just kind of having a look under the bonnet of my portfolio and seeing kind of how much non-US exposure I have. I actually found out that I'm more underweight US stocks than I thought I had. And I've got plenty of cash that's kind of waiting to be invested. So I'm just kind of figuring out the best places to kind of deploy that. I have a bit more of a punchy home bias than I thought at about 22%, which is quite high. I do still quite like the kind of attractions of UK small and mid caps. Which represent really good value. I've already kind of pointed that out, but I have been reappraising Europe, Japan, and India as well.
And that is it for this month's roundup of investment trust news. If you'd like to find out any more on the topics we've covered today, head over to the Kepler Trust Intelligence website, and we hope you join us again soon.
Past performance is not a reliable indicator of future results. The value of investments can fall as well as rise, and you may get back less than you invested when you decide to sell your investments. It is strongly recommended that if you are a private investor, independent financial advice should be taken before making any investment or financial decision. Please be aware that there can be a time lag when we release podcasts, meaning time-sensitive information may no longer be accurate at the time of publication. Kepler Partners LLP has a relationship with some of the companies covered in this podcast, which may impair its objectivity. Kepler Partners LLP is authorized and regulated by the Financial Conduct Authority.